Could you briefly share with us some of your highlights during this 2011 financial year?
Well, I think some of the key highlights are the fact that we've managed to have a 5 times increase in earnings to 7 billion rand, or just close to $1 billion. That for me was certainly an achievement that we're all proud of. But I think also the fact that we were able to increase our margins and show leverage. Oftentimes investors say that gold companies don't show leverage to the gold price. And the gold price went up over the year significantly. But in fact our earnings, as I've just demonstrated to you, went up even more significantly. So we've in fact managed to expand our margins in percentage terms and increase our earnings. One of the other highlights is being able to consolidate our interests in the Ghanaian and Peruvian assets we own by acquiring the minorities for $1 billion. Those deals have both proved to be very good transactions for us and have helped us to really diversify the portfolio such that today the international assets of Gold Fields now comprise around 52% of the total production and around about 60% of the earnings and the operating profits. And then the third highlight is advancing our growth portfolio. 3 years ago I mentioned we had a target of 5 million ounces either in development or in production by 2015. And a lot of people said, but where are you going to get it from? And today we can actually demonstrate that it's there. And it was a target up front, and I think a bold target. But today it's a target that I think is eminently achievable. And we have a pipeline ahead of us that is largely based on discovery. And it's much cheaper to find ounces with the drill bit than it is with expensive acquisitions where you have to issue a lot of paper, and oftentimes these deals are dilutive, certainly in the first few years.
What does your strategy entail on leveraging the increased gold price to adding to your bottom line?
Well, what we've got to do is we've got to continue with our rigid cost controls. We've got to make sure that we can eat into mining inflation. Mining inflation is running at 10% a year, at least at the moment. And we've demonstrated that we can come in much lower than that, probably less than half of that. There's more work to be done. We have to improve our efficiencies, and we have a business process re-engineering exercise across the group that we started at the beginning of last year, which is designed to improve our efficiencies and our costs right across the value chain of our operations, from the stope right through to the plant. And that has made a big difference, but we're still in the early phase of a lot of these activities. And I think you'll see over 2012 we'll make more progress in this regard and continue to show the leverage to the gold price. The most significant challenge for us is to improve our safety. Our safety has improved significantly over the last 3 years, and certainly it's halved in terms of the number of fatalities from the period prior to where I got into office over this 3 years. But regrettably it's still too high. So the biggest challenge for us is to further improve our safety and make sure that we can create a much better environment underground for our people. And that's going to be the #1 challenge for us, safety and health for our employees.